Rising coaches, welcome. We appreciate you joining us here right now. And we are pleased to start this new series that we're doing. This will be two parts. The first will be today, and then in a couple of weeks, we're going to release the new segment. And we're all going to talk about finances right here, right now. And I'm very, very pleased to welcome Corey Callahan. Corey is a dear friend of mine. We've known each other for about 20 years now. Corey's a financial advisor with Wells Fargo. And Corey has followed the inception of Rising Coaches from over a decade ago. So has firsthand knowledge of everything. So Corey, welcome and thanks for joining us.
Thank you for having me. I'm looking forward to helping you guys out. Really appreciate the opportunity.
So how's this going to work? We're going to have 5 questions today, and we'll have 5 questions next time. And let's just jump right into it. Let's have 5 questions about finance with Corey Callahan, financial advisor with Wells Fargo. Corey, first question is, let's talk about the importance of investing early in one's career, specifically the effect of compound interest.
Sure, great question. So compounding interest is really a critical benefit of long-term investing. When you're reinvesting gains, dividends, or interest from your investments, it really magnifies your returns over time. So the longer your money stays invested, the more you'll reinvest, which just gives greater opportunity for increased growth.
Yep.
It also is important to realize that compounded interest not only refers to the interest that you've earned on the savings or investments that you have, but it also refers to the interest that you've earned on your interest. When you focus on this year after year after year, you start to realize that the strength of compounding has really a huge impression on accumulating wealth.
Talk about the rule of 72. It's something I've heard a lot. Talk about the rule of 72.
Sure. Very simply, the rule of 72, which is an easy calculation to figure out on how long it will take to double the amount of money you have without adding any more principal. So you take the number 72, you divide that by a hypothetical rate of return that you may wish to earn, and then whatever that number equals is how many years it will take for that initial amount to double. So for example, if you calculate an annual average rate of return of 10%, then it will take you 7.2 years for you to double your initial capital. And remember that factors in reinvesting of dividends and interest, but that's not adding any new principal.
Okay. So for all those people that are really, really good at math, go ahead and do some addition in your head right now, or grab a piece of paper, and you can figure out just what the rule of 72 is all about. Corey, thanks for that. Question number 2. A lot of people know about the stock market and stocks and things like that, but not a lot of people may know about other options they have to invest other than just buying stocks directly. What are some of those options?
Sure. Individual stocks and individual bonds are a great way to invest in the market. However, investors really need to be aware of the risk that comes along with betting on one company or one position. Very important. There are many different investment risks that are associated with investing in an individual company. So before purchasing a stock or bond, I would recommend an investor consult with their financial advisor. I think that's very important. A simple way to diversify, though, and to take some risk away is to look at other investment products such as mutual funds and or ETFs, which stands for exchange traded funds. These are baskets of stocks, bonds, or maybe even both that generally have dozens of different positions within one portfolio that an investor can buy into. This can lower the overall risk, but it still can give the investor strong growth potential on the upside, which again is important. So my personal opinion is that using a blend of different investments works best when trying to limit risk and cost while also trying to see solid returns on the other side.
I wish I had a follow-up question, but I think that you explained it really, really well right there. So let's jump into question 3. What is a 401k, 403b, some of the things like that you hear all the time? What is a 401k and why is it important?
So a 401k plan is an employer-sponsored retirement account, okay? Now, typically the retirement plan offered to a college basketball coach will be with TIAA-CREF. All right, which has some unique benefits that may differ from your typical 401k plan. But let's just stick with the function of the 401k part. So it allows an employee to dedicate a percentage of their pre-tax salary to a retirement account. Now, these dollars are tax deductible, which is a huge upfront tax benefit when saving for retirement. Within the retirement plan itself, employees will typically have the option to invest in either mutual funds in annuities, although some plans may have broader options, but that's typically what you'll see in one of those plans.
All right. So in the coaching profession, there's some leaving of jobs or, getting jobs elsewhere. Should a coach who goes to a new program, whenever they change job, what does that look like from a retirement account perspective?
Good follow-up question. So given the environment in the world of coaching, which you know better than I do, but the turnover that comes along with it, rolling over a 401k plan to a new employer, an individual retirement account, which is an IRA, are both viable options if a coach finds themselves moving from one program to another. The term rollover is important because this option protects the account value in moving assets from one plan to another. A rollover avoids any tax burden and or penalty. So again, that money is protected in a sense when moving from the former employer plan to, again, either the new employer plan or an IRA. However, there are other options available when it comes to an employer-sponsored plan or change in jobs. I would recommend that a coach consult with a financial advisor to decide what option might be best for them.
And I appreciate that. Thank you very, very much. Fourth question for you. All right. What's the difference? What is an IRA and why is it important? Talk about the difference between a traditional IRA and a Roth IRA.
They're similar, but very different. So the traditional Roth IRA, both are individual retirement accounts, hence the term IRA, right? But they both have nice tax benefits, but they do work a little bit differently. So the traditional IRA is a tax deferred retirement account that may allow for someone to make tax deductible contributions. But then during their retirement years, their distributions will be taxed as ordinary income. So tax benefit up front, then there's a tax burden on the back end. On the other hand, the Roth IRA does not have tax deductible contributions, so no benefit up front, it's after tax money. But those assets within a Roth IRA are tax sheltered, as they are with a traditional IRA. But then the key difference being the distributions at retirement age from a Roth IRA, those can be tax free. So typically the Roth IRA might have a longer term tax benefit, but again, that really depends on what tax policy is at that point in time. And of course, neither of us know what the answer to that might be. But those are how they work differently. Traditional IRA has a little bit more of a upfront tax advantage. The Roth IRA more long-term down the road tax advantage.
I appreciate that. Thanks for explaining the difference. Fifth question. All right, we're in the fourth quarter, so we're asking the fifth question right here. All right, most coaches, especially young coaches, during their first job, second job, not making a lot of money, typically. How can they still be investing in their future when they aren't able to save a lot?
There are plenty of resources online to gauge if what you're saving is enough. But everyone's situation is different. Therefore, it's difficult to create the perfect plan, especially in the early years with lower income, potentially high expenses and debt. So if you're searching online for a budget or savings guidance, you'll see a lot about savings rule of thumb and budget rule methods. It can be quite overwhelming since each resource especially may have a different answer or solution for you. So in my opinion, if you're saving at least 10% of your gross income as a young coach, then you're putting yourself in a good position. Ideally, I'd like to see that number be a little bit closer to 20%, but a lot of coaches have student debt, especially in the early years. So therefore, it may be difficult to save 20% while trying to have some sort of social life, especially. As you know, I think you were there at one point. But paying down any debt can obviously be just as important as saving. So if you're in that position, as long as you're focused on doing both to some degree, things will look a lot better 3, 5, 10 years down the road. But I do believe if you can use 20% as a goal to get to, then your savings, your investment accounts will be in good position as a young coach and as you get further into your career.
Awesome. Well, that took probably about 5-7 minutes, and we appreciate your time. That was 5 questions on finance with Corey Callahan. Tune in for the next episode of it. We've got 5 more questions that coaches should know the answers to, or hopefully know the answers to, when talking about finances. So, Corey, thanks so much for coming on today.
Thank you, Andy. Appreciate it.